There are a million and one different ways to make money in commercial real estate, and with close to 200 videos already on this channel at this point, we've still only scratched the surface in talking about the different types of strategies that investors can implement to profitably invest in commercial real estate. However, for most commercial real estate investors and real estate private equity groups, even if the strategies themselves differ, the principles behind the investment making decisions that these groups tend to make are often very, very similar across the board. And regardless of the exact method that they choose, all investors want to minimize their chances of loss and maximize their profit potential at the same time. And to make sure that happens, there are a few fundamental frameworks that real estate investors tend to do their homework on every deal they analyze. And with that, in this video, let's walk through 4 of the most commonly used real estate investment principles implemented by major institutional commercial real estate investment firms to make investment decisions and how you can apply those same frameworks to your own deals in the future. So commercial real estate investing is kind of like running deals through a funnel. In most cases, for every 100 or so deals a real estate investment firm might underwrite, they may only put in offers on 10 of those deals, and they may only end up closing on one of those deals for a hit rate of about 1% of all deals they analyze. And when being so selective, some guiding principles need to be set in place in order to make decisions aside from just being able to see that the numbers might work on a specific deal. So in this video, let's walk through exactly what those guiding principles generally are in the industry, what makes investors want to buy a piece of commercial real estate in the first place, and the questions these investors are asking themselves to make sure they're maximizing their potential upside and protecting their downside in the process. So the first question a real estate investor is going to ask when analyzing a deal is, am I buying this property below replacement cost? And the replacement cost of real estate represents the cost to buy a parcel of land in the submarket and to build an identical new structure on that land. And this analysis is extremely important for an investor to run to understand whether it makes more sense to buy an existing property or to just go ahead and build that property themselves. If comparable new product can be built next door for the same price that you'd pay for the existing deal you're analyzing, this essentially means that a developer could come in and build brand new product right next door and essentially charge similar or even lower rents for a brand new property in the same exact location. And for renters, if given the option between 2 similar price points in the same place, a commercial or residential tenant is almost always going to choose the newer, nicer unit over an older, more rundown property, which in effect would lead to existing properties in the market actually needing to reduce their rents in order to just keep tenants from going across the street. But by buying at significantly below replacement cost, an investor can almost completely eliminate that risk since, for example, a developer that spends 30% more than you just to construct their project will very likely need to charge 30% higher rents just to make their numbers work. And when this happens, the opposite effect tends to ring true, with a newer, nicer product actually making your existing property comparatively cheap, which sometimes can even allow an investor to draft off of that new product and actually raise rents because of those new higher rent expectations in the market. The goal here is to make sure you have a significant buffer between what you're paying for an older property and what that property would cost to build today. And if you don't, it might make more sense to build new product directly rather than searching for existing inventory available in the market. Now, next up, speaking of new development, the next question real estate investors are going to ask themselves when analyzing a deal is, are there supply constraints in the immediate area? And supply constraints in real estate are exactly what they sound like, essentially factors that make it difficult, time-consuming, and/or prohibitively costly for developers to build new product in the market. And supply constraints can be due to constraints on land, like in many major cities and coastal locations where there just isn't much physical space to build on anymore, but also in metros where governmental restrictions have made the development process something that very few developers are able or willing to take on. Metros like San Francisco, New York City, Los Angeles, and Boston all tend to be some of the most supply constrained markets in the country, not only because these cities sit next to large bodies of water that physically prevent development in a certain direction, but also because of intense regulatory environments that can often make it very difficult to build, even on dry land. And as an investor in existing properties, if it's difficult or costly for developers to build new product in the immediate area, this is actually a really good thing because this is going to reduce your chances that supply is going to outpace demand in the future. And on the other end of the spectrum, metros where there is an abundance of land and a simple approvals process tend to be some of the most at-risk cities for supply getting out of hand, and these also tend to be the metros that have historically been the most boom and bust throughout past real estate cycles, with cities like Dallas, Atlanta, Las Vegas, and Phoenix all falling into this category. Ultimately, for an investor that wants to protect their capital and see the value of their investment grow, finding a deal in a supply constrained market will significantly protect that investor's downside and will maximize that investor's upside if demand does increase faster than planned. And speaking of demand, the third question that experienced real estate investors will ask when analyzing deals is, are there reasons to believe that demand for this property will increase in the future? Supply and demand fundamentals directly drive real estate values, and getting the demand side of the equation right is incredibly important even when investing in a supply constrained market. And one of the biggest factors that's going to affect what that demand is going to be is specifically job growth, which creates additional needs for not only office space, but also housing, retail, and even industrial warehouses as last mile distribution centers have become more in demand than they've ever been before. Experienced investors will also take a deep dive into how long they believe that demand might stick around, which can help determine a projected hold period and when they believe the right time is going to be to exit that investment. Metros that are heavily populated today but are also implementing higher taxes and creating unfriendly business environments are seeing both businesses and individuals packing their bags to move to lower cost states, and especially as remote work has become even more mainstream, this has led and will likely continue to lead to even more demand shifts in the future. And when evaluating demand risk, investors will also take a look at industry diversity in the market, or whether there is a singular concentration on one specific industry in the metro and what the impact on that property would be if that industry were to contract during their ownership period. Because of this, tech-heavy markets like San Francisco, Seattle, and Austin might give investors some pause if they think there may be a tech bubble on the way, while cities like New York or Chicago might worry investors if the US financial system starts to look like it's on shaky ground. And this obviously isn't to say that investors won't go to these cities because of these risks, but ultimately, at the end of the day, the goal is to be as well informed as possible to be able to predict where demand is headed by taking a look at job growth, industry diversification, business climate, and the political climate in the metro. And then finally, aside from replacement cost and supply and demand fundamentals, the last question on this list that experienced real estate investors will ask on any deal is there any meat left on the bone? And asking whether there is any meat left on the bone is typical commercial real estate jargon, but this question is really just asking if there is still upside remaining on the property, or if the seller has already captured all of the value to be had based on current market conditions. For example, in multifamily real estate, this usually looks like a deal with a significant portion of the units being in original condition and prime for an upgrade, or common areas lacking amenities that renters have grown to expect in today's market, like a pool, fitness center, or a dog park. And on commercial properties, this often looks like a deal with below market in-place leases that are about to expire or renew at fair market value, or common areas like lobbies and hallways that could use a refresh to attract a new tenant base looking for a more modern feel. Even for core investors looking for safer deals, these investors will still try to find opportunities to create some sort of value, whether that's the ability to trim excess expenses with more efficient management, the opportunity to implement a revenue management system to optimize rents at the property, or the ability to just do something as simple as improving the property's marketing efforts to attract a higher quality tenant base to the deal. Ultimately, the goal is almost always to find deals with some sort of upside potential, even for newer centrally located properties, and the more clearly that upside can be communicated to investors, the more likely those deals are to close. So, to sum this all up, if you're looking to tighten up your own real estate investment decision making principles right now by buying a deal below replacement cost, understanding whether the geographic market is supply constrained or not, researching local demand drivers and determining whether or not demand in the market is likely to increase in the future, and searching for any meat on the bone that allows you to add value to the deal, these things are going to put you well on your way to making smarter real estate investment decisions and finding the deals that both maximize your upside and minimize your downside in the process. And if you're looking to take a deeper dive into learning how to analyze and model commercial real estate deals, or if you're looking to break into the real estate industry and land a job at a top real estate investment, development, or brokerage firm, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 100 hours of course material on real estate financial modeling, investment analysis, and valuation. You'll get access to our entire library of pre-built acquisition, development, and waterfall models for multifamily, industrial, office, and retail deals. And you'll also get access to members-only private email-based career coaching if you're looking to break into the real estate industry and want some more personalized one-on-one guidance and feedback to help you get there. And if you like this video and want to see more videos on real estate investment analysis, make sure to hit the like button to let me know. And let me know in the comments any of the frameworks that you use to analyze your own deals that come your way. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.